And will the credit rating cut motivate French lawmakers to rein in their national debt? I spoke to Daniel Lacalle, professor of global economy at IE Business School in Madrid and chief economist at Tressis Hedge Fund. Here he is. Daniel, good to see you. Welcome back. So I got to talk to you about this. S&P downgrading the French credit rating. What are your thoughts on that?
I think it's an important piece of news that is likely to be ignored by the credit market, but it says a lot because this is happening in the middle of the next generation EU fund. This is happening also in an environment in which all the fiscal rules have been eliminated, and therefore the French economy should be growing and reducing the debt. However, government spending continues to be way too high and significantly higher than tax revenues despite record levels of tax revenues. What this is basically showing is that the French economy does not work because of massive government spending and because of massive intervention, not because of challenges coming from elsewhere. And it's also showing that it's extremely dangerous to fall under the illusion that government spending and deficit spending are going to drive growth faster. That is actually not happening. And the example of France should be a lesson for everybody. You have to remember that France has been in stagnation for almost 3 decades. More importantly, that it hasn't had a balanced budget since the late 70s.
Do you think this downgrade will motivate the French government, politicians, lawmakers to do anything, to make any changes?
No, unfortunately, no. Unfortunately, what we are likely to see is that in the next European elections, there will be calls for even higher government spending, and that there will be messages of subsidies and all kinds of government entitlement programs. But also, unfortunately, more messages about the central bank monetizing debt, etc. That's ultimately the only way in which governments would like to get out of this massive hole.
And you mentioned markets earlier. It seems like you're getting at that there won't be much of a material impact. Why would you say that people don't really care about this?
Well, people don't really care about this because they're falling under the mirage of central banks are going to disguise all fiscal problems because a very large number of market participants simply ignore fiscal imbalances, thinking that the central bank just needs to implement another round of quantitative easing and rate cuts, and that will make everything fine for markets. It might work in the short term, but it's getting very close to a law of diminishing returns, and it's pretty evident, to be fairly honest. Bond investors in Europe are suffering quite significantly in an environment that is leading the European Union to stagnation with high inflation, therefore stagflation.
You know, just like France, the United States, not a stranger to credit downgrades as well. Are there any parallels between the U.S. and France?
There are parallels. France is way ahead in interventionism and excessive government spending compared with the United States. But if the U.S. economy continues to pursue a model that is based on massive government spending, unsustainable deficits, and constantly bloating the size of government and the economy, it will achieve it like France did. Let's remember that France was a thriving economy only 35 years ago. It was a good, strong economy with big productive companies, with a thriving private sector. And it's easy to go slowly but surely increasing the size of government, increasing the size of bureaucratic spending, and believing that that is going to be fine because nothing has happened yet, which is the equivalent of accelerating in the middle of a race, thinking that you haven't crashed yet. No?
Thank you very much for your time today, Daniel.
Thank you so much.
Thank you for watching this video. Please subscribe to my channel.
like my videos, leave your comments below, and keep defending freedom. Thank you very much.